Good morning, everyone, and thank you for joining us this morning for the September FOMC meeting recap. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenter today by using the chat feature found at the bottom of your screen. You can find the chat feature by clicking the three dots on the bottom of your screen if you are on mobile, or selecting chat if you're joining from a computer. Before we begin, I'd like to introduce our economist on the call today, David Widmar, co-founder and managing partner of Agriculture Economic Insights. David was kind enough to glean the information from the meeting yesterday, interpret the data for us, and share his perspective of what yesterday's findings will mean for the overall economy and at the farm gate. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you all for joining us. This event will be recorded and distributed following the webinar. I'll send it over to David now.
Well, thank you, Alice, for that introduction, and thank you all for joining. As Alice said, happy to answer any and all of your questions as they come in, so be sure to submit those. But as you probably already saw in the headlines, the Fed cut that key interest rate, the Fed funds rate, by 25 basis points, and there's also some signaling that there could be more cuts ahead. So we're going to focus on how the Fed reached that decision here in September. We're going to dive into that signaling that I talked about earlier. We're going to break that down a little bit to give you some insight. And then we're going to tie that all back to the farm economy and specifically farm level interest rates and what that might have in store. So before we dive into some of the charts and the data, I was reviewing and watching everything that happened yesterday afternoon. And I thought that Jay Powell had a really great summary. Jay Powell, the chairman, had a really great summary of how we got to where we were in September. And so this is a lightly edited, this was a question that he was fielding. And so I cleaned it up just a little bit for readability, but you can go watch the full interview and that full question on the Federal Reserve website. But what he said was in three pieces here. There's three pieces. So the first one is, over the course of this year, thinking about the past 12 months, we've kept our policy at a restrictive level. We were able to do this because the labor market was in very solid condition with respect to job creation. I think that if we go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. What this means is the risks, which were clearly tilted towards inflation, are moving towards equality. The risks between the two goals have moved towards equality, and that suggests that we should be moving in the direction of neutral. This is what we did today. So Jay Powell was laying out this case. If we were thinking back a year ago, we were really focused on that inflation risk, and now we also have this labor concern. So inflation risk has came down a little bit. There's still some upside risk there, but now this job market risk has sort of kicked in over the last 3 or 4 months, and that's why they're moving this policy away from restrictive and they're moving it towards neutral. Now, you think about this, there's a spectrum here from restrictive, very restrictive, neutral, easing, and very accommodating. And so they're moving that back towards neutral. So we're not in a situation where they're trying to stimulate the economy. So that would cause a lot of concern, I think, for market participants if they're trying to stimulate the economy at this time, but they're simply taking their foot off the brake. Now, there's a lot of things that go into the economy. Of course, DC policymakers also have some impact on that. But this is sort of how I think we can set the stage here and we think about what we're going on is where we were for the last year, where we've been in the last few months of data, and where we're going to be going in the weeks and months ahead. So let's talk a little bit about the SEP, the Summary of Economic Projections, once a quarter, and the Fed participants, 19 participants, 12 of those are voting on the policy for each month on a rotating basis. But the idea here is they submit their expectations about where the economy and policy should be for the rest of the year into 2026, 27, and 28. And they summarize this as a way of kind of collecting insights. This isn't necessarily a great forecasting tool. This is a really great way to think about the distribution or the probability of future outcomes. The great idea to get an understanding as to where they were thinking when they made these policy decisions. So, a couple first observations I want to point out is when we were in September, the expectation for inflation adjusted GDP was 1.6 for 2025 and 1.8 for 2026. That's higher than they were back in the summer, about 2 percentage points, or yeah, 0.2 percentage points higher. That's a slight improvement in the outlook. Of course, we had some moderation from a year ago. We were above 2% a year ago in 2024. So there's that moderation is still in play, but the outlook has improved. When we take a look at unemployment, this top level number hasn't changed very much, but we do have some concerns. We're going to talk about that here in a little bit. Inflation is for 2025 is unchanged, but there's a little bit, maybe some stubborn inflation sticking in there. You see that 2026 value at 2.6%, now a little bit higher in 2026. But if we move to the Fed funds rate at the bottom of the list here, we see a lower rates sooner approach. And so we're going to get to a lower rate a little bit quicker in this current outlook, this current path of what the participants had in mind. So again, one of the things you might look at this and say is that, okay, the Fed funds rate got cut once. There's potentially two more cuts coming down the road. And I think that's a headline, that's a summary. That's a one-line takeaway from this. But we're going to spend just a little bit of time really diving into that because I think there's a wider range of possible outcomes on this Fed fund rate in 25 and even into 2026 and what that one summary headline would look like. So here's the dot plot. So each of these represents one of the 19 FOMC participants, and you can see there are not that many meetings left. There's not that much of calendar left in this year, but you can see there's a pretty wide range of expectations. When you think about going into 2026, you can still see there's about 150 basis points of spread there. That spread gets even wider as we head into 2027. And so let's talk about this spread specifically for 2025. So what I tried to do here is we've already priced in that one cut. So this one cut here is, brings us right into this between 4 and 4.25. So when asked about where they think the Fed funds rate should be at the end of the calendar year, one participant thinks that it could drift a little bit higher. But I think if you take a look at this kind of collectively, 9 participants think we'll have less than 2 cuts, and 10 of those participants think there will be 2 or more cuts. And so I think there's a lot of uncertainty here if we're going to get 1 more cut or 2 more cuts. I really want to make that clear. I don't want folks to be surprised if we don't get those 2 additional cuts or those 50 basis points of cut. That's what that headline top line number would suggest. But I think that the participants here are signaling there's a little bit of uncertainty here if it's 1 more or if it's 2 more. I think that's going to be really key to keep in mind. Another way we can look at this uncertainty is looking at in the blue shades where we were today, and then those dotted lines where we were in June. You can see that for the 2025 at the top, you can see there's a bit of a shift to the left, the general shift in towards lower interest rates. But then when you look at 2026, you see another shift to the left. So in both cases, folks generally move their expectations towards a lower interest rates sooner approach, but there's still a wide range of observations, still a wide range of outcomes that persist. And I think that's going to be a lot of uncertainty here. And as one of the takeaways from this is that there is a lot of the Fed's job is getting more difficult. Whenever we have low unemployment and we have high inflation, the signals gave them a lot of cover to keep rates in that restrictive position. Now we're getting to a situation where there's still inflation risk, but now there's some labor risk. They have to really navigate that carefully. I think that's why we have this wide range of expectations. Let's talk a little bit more about the labor situation. Labor, we're sort of shifting gears here. We talked about this over the summer. It looked like the attention pendulum was going to swing away from inflation and more back into the labor side of the equation. And I think that's where we definitely are here in this, when you look at the Jay Powell's comments. So let's look at the unemployment rate. You can see this has been working its way slowly higher. I think the commentary was something around the highest unemployment rate in 4 years, and that's true. But if you look back throughout history, we're still at a somewhat low level of unemployment. So the unemployment rate itself isn't causing concern. The real concern here is coming out of the warning light, if you would, is flashing when it comes to the change in jobs. And so we call this job creation. And so you can think about this as a kind of a month over month look at how many jobs there are in the economy, and this change gives us an idea of how many jobs were added. So if you just take a look at this data going back to uh, 2020, you can see that the values that we've been recording and observing over the last few months, this June, July, August, and even May, you'll see that this is running much lower than we saw throughout most of the pandemic recovery, but then also this 23, 24 timeframe. And so that's where the economy, that's where the Federal Reserve is really watching this, making sure that we don't have a situation where this job creation goes backwards. That would fuel this unemployment story earlier. So this is a little bit of a leading indicator to that unemployment story. There's always a question as to how many jobs we need to be creating in the economy to reach some sort of break even. It's something greater than zero, and that's always a big question mark. But the Fed's position and the Fed's commentary, and Jay Powell spoke to this in his remarks, is that the belief is that we might have slipped below the break even, and so we're not creating enough jobs, and that would start to push unemployment rates higher. Again, this isn't a concern at this point, but the idea here is that if we don't see this, we need to see this improvement out of the labor market to give some cover and take some pressure off the unemployment rate. So let's talk a little bit about interest rates specifically. I think we've been talking about this for quite a while, is this yield curve inversion. And I think over the last few months, we've talked about so long the inverted yield curve, this inverted yield curve that we saw for many, many months throughout 2022 and through the end of 2024 has gone away. So that inverted yield curve, I'm showing in blue 10-year treasuries, and in the green line 1-year treasuries. So 10-year treasuries are now trading above 1-year treasuries. This is what we'd expect to see. This is what sort of our expectations would be for a kind of a normal situation. But what I want to point out here is look how stubborn and sticky these 10-year treasuries have been. There's been some bouncing around a little bit, but if you take a look at the 1-year treasuries, these short dated interest rates, they've fallen by more than 100 basis points, or maybe 150 basis points over the last 12 to 18 months. But the 10-year treasuries have been bouncing around, but mostly trading sideways. And they've been trading pretty sideways really throughout most of 2025. So we're going to keep an eye on that. It's this 10-year treasury that really links itself a lot to real estate loans in the farm economy. And so while the Fed is signaling the potential for lower interest rates, and they've been lowering interest rates over the last 12 to 18 months, this stubbornness in the 10-year treasuries is why producers maybe haven't seen as much change in the farm level interest rates as they would have anticipated. We're going to talk a little bit about that here in the next slide. And what we've done here, what my team at AEI, we think about this a lot, and it's just, we created an index, and the index here is this idea of how pricey are farm interest rates relative to all the other interest rates throughout the economy. So we're taking a look at those slides, that those 10-year treasuries and those 1-year treasuries that we showed you earlier. And we're also thinking about the Fed funds rates. And we built a model here. And what we've seen is that this sticky index gives us an idea of where are farm interest rates based on those other factors. So we model and forecast where these rates should be. And what I want to point out here is that really since 2022, when the Fed started raising those Fed funds rates, farm interest rates have been low or relatively cheap compared to the 10-year treasuries and the 1-year treasuries, all these other factors. And so what we see here is there's a little bit of a muting effect. So the Fed funds rate went up 550 basis points, and farm real estate loans went up between 300 and 350 basis points. And so we saw a situation where we didn't see a direct pricing in. So this gave us a little bit of cover, a little bit of shelter from the rising interest rate environment. And that peaked about a year ago or so. And now we start to see farm interest rates becoming not quite as cheap. They're starting to revert back to this neutral environment. But the takeaway here is we're still in this negative territory. And what I want to point out here is when we're in this negative territory, that means it's going to be less additive. And so when the Fed cuts Fed funds rate by maybe 25 basis points or 50 basis points, not all of that is going to work its way through to real estate loans. There's going to be a subdued situation here. And even if we see some changes in the 10-year treasuries, they're going to be subdued as they work their way into farm interest rates. So the takeaway here is really, you got to untangle Fed funds actions with the 10-year treasuries. We've seen that unfold over the last 12 months, but then we have to untangle another layer, which is getting to those farm real estate loans. So I think all this points to a situation where farm interest rates are going to be sticky. They're going to be slow to work their way lower. And in fact, our farm interest rate model, this comes out of interest rates that are collected across the entire farm economy. So this isn't one lending institution. This isn't one particular borrower or anything that way. So you can imagine there's a range of interest rates that would be observed throughout this average. But the idea here is that we've seen some decrease in these farm real estate interest rates. But when we start looking into 2026, 27, and even maybe out to 2028, the forecast model just doesn't show enough of a decrease in the median FOMC expectation from that chart earlier to really see a big change in these farm level real estate loans. Of course, a lot can change. A lot can change in those summary of economic projections that the Fed has put out. And of course, that spread that we talked about earlier, those could always change as well. But when we sit here today, there is some possibility for improvement, but the range is pretty it's somewhat limited here. We have to really watch these 10-year treasuries because that's going to be an important indicator. So before I get to your questions, I just want to wrap up with a few slides here. The first one is the timeline. October, they have another FOMC meeting, and in December they have their final meeting for the year, and there's a updated summary of expectations. We'll have another webinar to debrief and wrap up and provide you some insights on that in December. But so there's two more meetings and this idea of maybe two additional rate cuts. So you can see them doing one cut at each meeting. So we'll keep an eye on that. And then I guess another big point to keep an eye on is that Jay Powell's term as chair, his second term as chair, ends in May. So there's conversations already started about who might be the Fed chair when we start to get into June next summer. And that, of course, could impact to some degree, a limited degree, that could start to impact some of the direction of the Fed starting to take. So if I'm going to wrap this up in just sort of a few bullet points I want to keep in mind, I said earlier at the beginning, the Fed's job is getting harder. I think the watch list, the top of the watch list is this unemployment metric. The back burner is now inflation. And a lot of times we talk about this dual mandate, and there's this great chart that the Fed puts out that has a dual mandate bullseye. The idea here is there's a sweet spot here in the middle, and then there's a kind of a range of comfort. But if they start getting out of that range of comfort, they're going to have to start making decisions. And so what Jay Powell was saying at the very beginning when I started that, he was saying we had inflation pretty high, but low unemployment. So that gave them a lot of flexibility to keep rates, to raise rates and to keep them somewhat high, to try to get inflation working its way back down. And we're still sitting at 3% on inflation. So the inflation is still running warm. What the Fed's really trying to avoid is they want to avoid a situation. This is what we think about as the danger zone, is if you have high inflation and high unemployment, that starts to feel like the late 70s and early 1980s. That's that danger zone. The Fed really gets their hands tied in that situation. There isn't a lot of great levels for them to move to try to help the economy in that situation. So this is the box that we're trying to avoid. This is the area that we're trying to avoid. I think this is this kind of risk reassessment that the Fed was taking is, okay, let's put inflation to the back burner a little bit. Let's make sure we don't get into an employment or a jobs challenge. The final point, as I mentioned just a few slides ago, I think farm real estate rates are going to be somewhat sticky and stubborn as we look out for the next 12 months. There could be some improvement for those shorter term notes, like the operating line of credit or machinery rates. We could start to see those move a little bit lower if we do get, especially if we get a couple more rate cuts out of the Fed fund here at the end of 2025. So that's all I have for prepared slides today. And we have a few minutes here for questions as they come in. So Alice, I'm going to turn it back over to you and see if we have any questions coming in.
Thanks so much, David, for all of that great information and this recap for us. As a reminder, if you've got any questions, drop them in the chat to us and we will ask them. We do have a couple. One of them is, David, inflation hasn't been discussed as much in recent months, but it's still on your watch list. Is inflation behind us?
I think it's a great question. There's a lot of moving pieces that inflation. Of course, tariffs are a huge concern as we think about that. The Fed's still talking about the possibility of a one-time price hike from the tariffs that have been working their way through the system. I think that is somewhat of this story of sticking around 3% and then maybe a bit of a decrease. I think it's part of the reason why the Fed is also able to put that inflation category a little bit on the back burner. But I will say, if you dive into the inflation data, there's sort of two big components of inflation: inflation from services, and which is often thought to be linked to wages in the job market. That's been cooling actually, and so that's again another concern for the Fed with the job market. But there's also inflation that is in goods, and so goods inflation has increased over the last few months and over the last throughout 2025. That's causing a little bit of pause or worth keeping in mind. So that inflation number at 3%, there's a lot of moving pieces that go into that. But keep in mind, services are decreasing, services is coming down, but also good inflation, which that's the one that's linked to tariffs. That's been drifting a little bit higher. So we'll keep an eye on that one moving forward.
Yep. Another question. What signals should we watch for that would tip the balance back towards either inflation or unemployment concerns?
Well, that summary of economic projections is that's why I think that's a really a good golden standard for why we as observers get so much value out of that. That's a fairly new output from the Federal Reserve System, and I hope it's an output that they keep providing us. But I think if we see inflation starting to get above that 3%, the Fed's going to shift their focus back to inflation. If we see another situation where the unemployment rate starts to drift above that 4 to 4.5 window, they're going to put even more emphasis. So I think if unemployment gets above that 4.5% threshold, we could see the Fed moving into an easing situation or a stimulating situation where they're trying to boost the economy. If we see or inflation get above 3 or maybe even 3.5%, we could see them maybe becoming more restrictive. And I think that's going to be really kind of a guiding philosophy as we move into 2026. Once we get some of the job market data under control, or we get some better idea or handle of how that job market data has been moving through, and we get a better idea of how the tariffs and inflation are responding.
Thank you. And the last one that I have, if you've got a question, drop it in that chat to us, is immigration policy or AI affecting the employment data yet?
Yeah, that's a great point. It's a great comment. There's a lot of, like I said, the Fed's job is getting more difficult, but there's also just a lot of moving pieces that they're having to consider for each of these factors. So inflation has tariffs that they're weighing and the effect of that. And on the labor market, there's a lot of moving pieces in that component as well. So Jay Powell, last few months, I think even throughout the summer, he said that there's been a curious equilibrium in the labor market. And what that's been saying is sort of the supply of folks entering the market has decreased. There's fewer folks looking to get into the job market, but also the number of companies hiring has came down. And so those have been coming down collectively. That's where we saw that those new jobs coming down. So there isn't necessarily an out of balance here between supply and demand. It's just that they both came down together. And why that's a concern is that if we see a wave of layoffs, that could really start to be concerning because there's not a lot of jobs there to pick that up. The layoffs could take more time to find a rehire. And so it's kind of a question mark is how much of that can be attributed to immigration. How much of that is employers on the demand side saying, I want to hold off on creating these new jobs to really see how our business or our organization can absorb some of the new AI infrastructure that we've put in. We haven't talked about spending a little bit, but I think another interesting observation is that there's been a lot of business investment that's been going into business investment on the spending side of the dollars going into the economy, flowing into the economy. That's actually been increasing a little bit. Consumer spending is down just a little bit, but this business investment has been going up. So maybe there's a little bit of a substitution or just a pause in the understanding the calculus between capital in terms of AI and in labor in terms of jobs hired.
David, we've got another question here in the chat. Most of us understand that mortgage rates are are tracking similarly to the 10-year Treasury. I may have missed it, but what is causing Treasury bonds to be so sticky?
It's a really great question. I think there's always a lot of speculation and um, questions as to what was going on there. And so I think one of the things that happens is when the Fed started to raise rates all the way back in 2022, they were saying they felt like it was a bit of a short term. There was the expectation that the Fed would raise rates and then bring them back down. So I think folks that were out there buying and selling bonds and deep into the market were pricing in this idea that we'd have rates go up and then rates would come down just a little bit. The second piece there is that those bonds sort of didn't go up as much as we might have been expected because the expectations for inflation were short term in nature. Folks weren't anticipating inflation to be a long term issue. So there wasn't as much price pressure on those bonds initially. So a lot of things in this current bond market really go back to when we saw inflation come in 2022, short term expectation. The expectations around interest rates, again, the idea of a rise and then a decrease, set the stage for 10-year Treasury just not going up as much as maybe you would initially anticipated. So that led to that yield curve inversion. So that idea of short-term rates got above the long-term rates. That sometimes is seen as a recession indicator, but I think it was mostly attributable to the idea that this rate hike was in a short-term nature. Now we're starting to go on the backside of that, where the rates are starting to come down. So we're getting the benefits of that short-term nature, but those 10-year Treasuries just don't see a lot of reason or expectation to work their way lower, given the long run. I think the other piece here, and that some of economic projections showed that, is that the Fed has expectations of long run interest rates for the Fed funds rate at about 3%. So when you think about the long run, before the pandemic, we were in a very low interest rate environment. After the pandemic, we were at a very low interest rate, a zero interest rate environment for the Fed funds rates. And so we're returning, the new equilibrium isn't that zero. It's that 3% long run projection that the Fed is anchoring towards and is moving towards. And so it's a combination of all those factors. But yeah, I think that 10-year Treasuries are going to be pretty sticky for a while. And I think that's really a factor of the market is expecting the Fed to get us back towards 3% on the Fed funds rates. If that starts to change, if that lowers, then maybe the 10-year Treasuries would adjust.
Thank you so much, David. That looks like that's the end of our questions. Thank you for all of this information today. Thank you to everyone that has joined us. And as a reminder, this recording will go out to everyone. So if you miss something and want to hear it again, you can. But have a great day.